Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining me for another one of these Beer Money Sundays. I've got mine. Hope you've got yours, whether it's an adult beverage or otherwise. Let me know where you're coming to us from, anywhere out there in the Bowtie Nation. I already see a lot of you longtime Bowtie members, Bowtie citizens out there. Ambrose, Lose Cat, thank you for being here. Philip, Eugene, Minerva. Got a great episode for you today. Great live stream. Love doing these just as a way to kind of connect with you out there in the community. A little bit more informal. Take off the tie and just kind of talk back and forth about the market. Try doing these every 2 weeks. But it's a little bit more irregular lately. I got a lot of other stuff planned and trying to do. So just make sure you're subscribed to the channel and you got that bell notification clicked so you're notified when these come out. We want to get started here because it's something I think is important to talk about. A lot of banks came out just this last week with warnings on the economy. Goldman Sachs, Morgan Stanley, Citigroup, all issuing warnings over that. And I think this is something it's important to talk about. Okay, I know a lot of people are out there. They're going to say, "Oh, you're just trying to spread FUD and fear, and if you just don't talk about it, then it'll go away, right?" Yeah, come on, folks. When did anything ever go away by ignoring it? Okay, if that worked, then that little red rash that you've got because, well, you know what you were doing, it would just go away because you're just trying to ignore it. You cannot ignore the stock market. Okay, you cannot ignore the warnings, the signals. You got to look at this stuff dispassionately. You can't get passionate or emotional about your stocks or the market. You just got to look at this, take the facts in stride, look at them all, the good and the bad, and use that in your investing strategy. Because really what we're getting into the worst months for returns. We're seeing a lot of those warning signs out in the economy. So it is something you want to look at. We can just look at the history right here. August and September, historically the worst months of the year, and a lot of that is just seasonal factors, right? People are out for the summer, so August is generally pretty bad because volatility and trading is pretty low. September, also a little bit of seasonal factors going on there, and actually October. October is usually in this time period and even longer out, it is usually positive, but that is where we see the biggest crashes. The crashes of a 1907, 1929, 1987, all in October. So they're just something psychological seems to be in October that kind of tips the market. A lot of those crashes, though, were kind of signaled in September. The stock market kind of started coming down in September, started giving those warning signs. So that's something that we need to look at and we need to watch. It doesn't mean you pull all your money out of the stock market. It doesn't mean you sell everything and go to cash or anything like that. But you need to watch these signals and you need to develop your short-term investing strategy around that. Now, there is a such thing, obviously, as a long-term investing strategy. I've got stocks that I buy that I'll never sell, no matter what the economy does. In fact, I've pinned up in the chat box free report the top 5 stocks in my own portfolio, 5 stocks that I'm basically just holding and holding forever. So click through. I'll leave a link into the description below for that. It's a totally free report. Sign up by email. It's to the Motley Fool. They're going to send you some emails, but it's totally no obligation, totally free. They're going to send you some emails about the stock advisor service that they have. I use the service. They've got some great reports and great ideas in the stock advisor service. I can't remember what it is. I think it's like maybe $10-12 a month. It's not a whole lot, but if you don't want that, then don't sign up for it. It's totally free, no obligation to get this report from me. It's just something that I wanted to offer to you out there in the community, and it helps support the channel. So I appreciate that. Click through, put in your email address in there, and they'll send you that free report. But I want to get started here because I want to get to those kind of the pros and the cons that the market is sending us. The signals, positive as well as negative. It's not all negative out there, folks. There are some real strong positive signals that we have in the market that could send stocks higher. And I want to talk about those just as much as some of the warning signs, right? So I want to get to those. I want to get to the question and answer. Love that part of the live stream every week. Just a chance to connect with you out there in the community. If you didn't see the videos last week, I had a really personal story on dividend investing out on Monday. Check that out. Really kind of share why I prefer dividends against a lot of other stocks. Growth stocks have actually beaten dividends over probably about the last 10 years, 10, 15 years even. And that's not typical for, the stock market history. Typically, value stocks, dividend investing beats those growth stocks. But over the last 10 years, it's been growth all the way, those big tech names and that kind of thing. So why do I still prefer dividend stocks? And that video kind of goes into that personal story about, financial stability and times in my life where I really, where my family really needed that kind of financial stability that I think only dividends can provide. So check that one out. That was last Monday, I think. Tomorrow we've got a short-term investing strategies video coming up. Always real popular on the channel. So check that one out. And and we've got Monday, Wednesday, and Friday videos coming out. Check those out. Now I want to get to this, right? Because there is a bullish argument to the market. There's a bearish argument to market. Your job as an investor, especially if you've got any kind of a horizon that's less than 5 years, I'd say even less than 10 years, to needing the money in your investments. Even if you've got a horizon that's longer than 10 years, though, if you're more trading, if you're using some of those shorter term investing strategies, then you want to be balancing the bullish argument with the bearish argument, and really looking for those sectors that are going to benefit. Again, just because I see some warning signs and signals in the market, that doesn't mean we sell out of our stocks, right? You might shift to other sectors, other stocks in other sectors. And this is really what we did, last October, last November, when we were starting our Bowtie Nation portfolio for this year. We shifted into energy, we shifted into financials, following a lot of those signals that we were getting out of the market. And, that's why it's beating the market right now. That's why that portfolio that we have is beating the market by, I think it's about 12% beating the market. It's up something like 27% for the year. So there is a reason why you watch these signals, you watch these warning signs, and use those in your investing strategy, not just to say, I think the stock market is going to crash, and you sell out of everything. Okay, so I want to cover the bullish argument first, because we're always trying to stay positive and look at the upside, and I think over the long term, it pays to be positive in the market, right? No matter how hard the crash is, no matter how hard the crash has been in the past, the market has always gone up, right? So it pays to stay positive. It pays to stay invested in the market, right? And right now, it's hard to be negative because Chair Powell of the Federal Reserve is still extremely accommodative, right? Chairman Powell just does not want to raise interest rates. He does not want to slow that taper. The Fed is still buying $120 billion in bonds, mortgage bonds and treasury bonds every single month. And when they buy those bonds, they push cash out into the economy, right? So it's a stimulative effect on the economy. Obviously, rates are near zero. Even long-term rates are about the lowest they've been in history. And, despite an economy that looks pretty darn good, we're expecting 6-7% economic growth this year in the U.S. and internationally around 6%. Unemployment is back down to the low 5% handle, which is really close to where the Fed says is kind of that natural rate of unemployment, that rate of unemployment that you're not going to get under, and that's when they start raising rates. And even despite all those signals of a very healthy economy, they don't want to stop that stimulus, right? We're expecting trillions more in stimulus from the government, whether it's through the infrastructure bill or just regular budget spending. So there is a lot of money being pumped out into the economy, and we'll look at a chart here in a little bit that shows just how that is affecting the stock market. Okay, because it is affecting the stock market and is a very, very strong piece of support for the market. We've also got household and corporate savings, right? We've got about $2 trillion in each of those, household and corporate savings, beyond what they were saving in late 2019, early 2020. That is just excess. It's money from all the stimulus payments and all the other things that households saved up. We had a household savings rate that was upwards of 20 and 30%, which we've never seen that in history. Right, so households were saving an immense amount of money, up to $2 trillion across the U.S. right now, Corporations have also been saving a lot of money, fearful of really spending it on capital expenditures and growth and that kind of thing. So they've been saving it along. That's about another $2 trillion. So you've got about $4 trillion between households and corporations that are excess savings beyond what they've had in the past that they could be out spending once the economy really opens up. So $4 trillion, a little bit more than a $20 trillion economy. That's about a 20% boost to the economy right there. So even as we look at a lot of these warning signs and signals in the market that point to a correction, we had 4 straight down days last week. Even as we look to a lot of that stuff, then you just are not going to see a full-on stock market crash. Okay, it is very, very possible. The potential is there that we get something like a 5 to a 10% correction in stocks, which are actually much more common than people believe or people understand. But with that much money, getting ready to be spent in the economy, that much pent-up demand, the rates as low as they are, a Fed that is still very accommodative, you're not going to get a crash in stocks. So, how do you use that? How do you use some of these signals to really tweak your investing strategy and really look forward to 2022, really? So I want to look at some of these things. Some of the ideas here are it's kind of deep into the economics, right? Because at its real core, that's what the stock market follows. The stock market follows corporate earnings, right? Profits at corporations and the profits that go on those stocks. The profits follow the economy, right? So if you look deeper at the economy, kind of see what is pushing the economy, then you get a better sense of that bigger picture in stocks, right? And right now, one of the biggest things I've been watching is just the money supply, right? And we've talked about this in the past, where the Fed has pumped so much money into the system through low rates, through bond buying, all that. The money supply has gone up 40% in the last 2 years, folks. That's the biggest 2-year jump ever, right? To give you a perspective of that, in the past, historically, the money supply, so the amount of cash in the system, goes up about 5% a year. Okay, that's kind of the rate that the Fed manages. The Treasury prints, the Fed manages as far as bond buying and bond selling, that kind of thing, to keep that kind of stable 5% growth, right? And, so 5% historically, 40% over the last 2 years. And that's really where we see all that savings by households and by corporations, because obviously people just weren't spending it, right? People were locked down. Corporations were scared about a recession or a depression or anything like that, so they weren't spending it. So that 40% in money supply growth really just went into savings, right? And that's what we're looking at as far as that pent-up demand and that kind of thing. But it's also feeding into inflation. We've seen a massive spike in inflation over the last few months. It's about 5%. The CPI, the Consumer Price Index, comes out on Tuesday. That's probably the biggest news of the week to be watching for, is that Consumer Price Index, and to see really where that is. Now, a lot of people, you're going to see the report. It's probably going to be a kind of hot. It's probably going to show another month of very high inflation. And what I'm looking at really with that CPI is we're going to start seeing rents increase in that. I've got a graph on this I can show you if I can find it. But basically, rents. Okay, so the average rent increases across the U.S. is 30% of that CPI number of total consumer inflation. Rents is about a third of that, right? And we really haven't seen that increase very much over the last year. Why? Even though house prices have gone up like 16%, house prices have gone up, the fastest on record over this last year. And that's another function of that money supply growing and that inflation. But we just haven't seen rents going up, right? And that's acted to kind of hold down inflation, actually, believe it or not. Well, why haven't we seen rents increase? Well, because of all these moratoriums. Landlords weren't going to increase the rent if they couldn't kick people out for non-payment, or if they didn't think they would get it. Okay, so landlords have actually only been increasing rent by about 2% on an annualized basis over the last few months. Okay, so compare that 2% increase in average rents with a 16% increase on home prices. All right, you would expect the two to move pretty closely, right? Because obviously the more expensive it is to buy a home, then more people are going to be renting. Well, that's going to push up that supply and demand factor. That's going to push up the rent prices. But it's been broken. It's been broken because of those moratoriums. And as those moratoriums, those eviction moratoriums and foreclosure moratoriums come off, then I think you start seeing those rent increases start going higher, right? To catch up really with the supply and demand picture. Okay, so over the next few months, start watching for those that is called owner's equivalent rent. That's going to start being a much bigger factor in inflation, and it's why a lot of the reason why I think inflation is going to be a lot more persistent and a lot higher than a lot of economists and the Federal Reserve really believe. Okay, so. But back to the CPI that comes out Tuesday, I think that's going to be high, and you're going to hear a lot of people start saying, well, this just forces the Fed's hand. This is forcing Chair Powell's hand. They're going to meet here, not this week, but the next week, the Federal Reserve, they're going to meet and kind of do their policy decisions and all that. And people are going to get spooked. People are going to say, well, this higher inflation makes it that Powell has to start tapering. They have to start bringing back some of this money that the Fed is pumping into the economy. And, I don't believe it. I don't. Just watching Chair Powell, watching the rest of the Fed members, over these last, years, but over the past few months, they are doing everything they can to slow go on this, on this stimulus, right? So what I think is going to happen is you're going to get that CPI number. It's going to be high. It's going to spook the markets a little bit, and people are going to start talking about this. But then when you get that Fed meeting, it's Wednesday of next week, not this week, but the next week. Then I think it's going to be a little bit more bullish than people expected. People expect if we do have a high CPI number, high inflation this Tuesday, people are going to expect the Fed to come out and say, okay, you know what, we're going to start tapering right now. We're going to taper fast, and eventually we're going to start raising rates. We have to because we have to get inflation under control. Well, what we've seen from Powell in the past, and what I think we're going to see from him in the Wednesday after this is again he's going to come out and he's going to play he's going to play daddy to the markets. All right, he's going to try to soothe the markets. He's going to say, you know what, inflation is running higher than expected, but it's still temporary. They're gonna focus on that transitory word, still stick to that argument and say that we've still got a lot of unemployment out there and a lot of things like that. So they're going to kind of soothe the market. So if we do get a big sell-off on the CPI report Tuesday, I think it comes back and turns a little bit more positive when the Fed actually comes out on Wednesday of next, because if there's one thing that has been clear over the past several months is that Chair Powell just does not want to spook the markets with this kind of thing, right? And that accommodative stance, that stimulus from the Fed is so important. And this is something we've looked at on the channel before. If you want an idea of how important the Federal Reserve and their that $120 billion bond buying is, that zero interest rates, all the stimulus that they're pumping out into the system. If you want an idea of how important that is, just look at a chart. Just look at pretty much any chart. I've got the FANG charts, right? The Facebook, Apple, Amazon, Google, Microsoft, Netflix, and Tesla here in light blue, but you can pretty much use almost any chart. You could use the S&P 500, you can use the NASDAQ for this, because they all show pretty much the same thing. You've got those stocks in light blue. In dark blue, you've got the central bank liquidity, right? So all this money being pushed out into the system from the Federal Reserve, and they line up almost exactly. You see since the financial crash, the recession in 2009, they both increased pretty well at a decent pace there until right during the pandemic. Right when the pandemic started and all this stimulus got pushed out. And I'm not saying that we didn't need the stimulus. The stimulus definitely kept us from some kind of a depression era, of events. But they have just gone overboard with how much money they're pumping into the system, all the stimulus and everything. And you see it in the stock market. You see that 40% money supply growth in the last 2 years in stocks because it hasn't been spent. It hasn't gone anywhere else except in stocks, right? So you've got the central bank increasing their balance sheet, which when they increase their balance sheet, they buy those bonds and they push that cash out into the system, increased it by $5-6 billion or $1 trillion. That's trillion with a T, and you've just seen a huge jump in these stocks, right? It's really created the market in which we live right now. We look at another chart here. kind of these signals, the price, the valuations in the market, the price to sales ratio on the S&P 500 is now at 3 times. That's 3 times for all the companies in the S&P 500, the highest since 2000. We can look at some charts by FactSet here. I love FactSet as a research tool. We'll look at a few of these charts. This first one is the sector level forward 12-month PE ratios, right? And as always, the dark blue there is the current. The light green, or the green there, is the 10-year average, right? So it's a great way to look at each stock sector, each sector of the economy, see how expensive it is right now compared to that 10-year average, compared to history, right? And as we've seen, every single stock sector is trading above its 10-year average as far as price to earnings, right? So premium on those prices over valuations, and some more than others, and really it's, you look at consumer discretionary here, this first one trading for 30.3 times on a price to earnings basis versus 20.6 times on that 10-year average. So that's a 50% premium on those stocks, And while I do think those start coming down, as we start seeing earnings growth continue to grow higher, we're expecting something like 43% earnings growth this year and 9% next year. So a real fast deceleration in earnings growth next year. But as those earnings continue to increase, then you start seeing these PE ratios come down a little bit. But 50%. PE ratio on those consumer discretionary stocks is really amazing. 50% premium on those. Same thing with IT, information technology, tech stocks, trading for 26, almost 27 times PE ratio versus 17 times on that long-term average. So there, about 9, that's about another 50% premium on there. So you can really get a sense of how expensive the market is, how expensive each sector is. You look over here, some of the relatively cheaper ones, energy selling for 12.6 times on a PE ratio basis, 8.7 times, long-term average. So still overvalued, not quite as much as some of these others. Financials trading for 14 times. The long-term average there is 12.6. So financials, materials, healthcare, all three trading very much closer to their long-term averages. So, if you're a value investor or if you're looking to switch into value, being afraid of maybe a stock market correction or weakness in some of these growth stocks, some of these tech stocks, then you want to shift to value. You want to shift to, stocks that aren't expensive to begin with, so maybe they don't have a much farther to run. So you want to look at the financials, materials, and the healthcare sectors. We can also look at just the market, the overall market. The blue here is, the dark blue here is the forward 12-month earnings per share. Well, let's look at this one instead. There you go. There's the PE ratio. Just plain and simple, the PE ratio there at 21 times. And you can see the green is the 5-year average. The blue dash line is the 10-year average. 10-year average right around 16 and a half. So right now trading at 21, long-term average of 16. That's 5. That's little under 30%, right? So a little bit under 30% premium on the market right now. 30% overvalued versus that long-term average. I want to go to one more chart that's always real popular here, and then we'll get to more of those signals, those market signals and stuff. But this is the sector level bottom up target price versus closing price. Okay, and so what this is analysts have their price targets on every company in the S&P 500. That sector level bottom up target price, the target price on every company in there versus the closing price, right? So this is actually the percent return those analysts see on all the stocks in each sector over the next year. Okay, so and you don't just jump into these sectors, because you got to use this in your own strategy. Use this with your own thinking and say whether you agree with this or whether you don't. Okay, so first, if you look at these, then we've got energy with an expected 29% return over the next year. Okay, so the target prices for all the companies in the energy sector in the S&P 500 are 29% above the closing price, right? So that's the highest one. They've also got industrials here, 15% return, materials, 14%, consumer discretionary, 13% return, right? On the other end here, you've got utilities, real estate, and consumer staples. So basically, all the safety sectors are expected to post the lowest returns in the market over the next year. Utilities only 6%, real estate 6.5%, consumer staples 9%. So when you look at something like this, then what do you think to yourself? You think to yourself, okay, what are the analysts thinking is going to happen in the market? Okay, they're thinking, energy, the cyclicals, industrials, materials, all cyclical stocks, all do well with the economy when the economy grows, moderate inflation, that kind of thing. So obviously, analysts as a whole, analysts as a group think that the economy is going to do well. You're going to have slight to moderate inflation. Energy prices are going to stay high, right? So they're seeing good things in energy, industrials, and materials. On the other side here, what are they saying? Utilities, real estate, and consumer staples are going to lag. Those are all the safety sectors. So obviously, if people are still plowing money into riskier stocks, cyclical stocks, that kind of thing, they don't need the safety stock sectors, right? So maybe a little bit on those. They're also saying here, I think, that interest rate inflation is going to go higher. Interest rates are going to go higher, okay? Because what you see in these three sectors, consumer staples, real estate, and utilities, obviously those are big dividend paying sectors, right? So what happens is when interest rates increase, then investors look at the dividends they can get from these three sectors, and they look at higher interest rates, and they say, well, you know what? I'm just going to invest in bonds or some other interest-bearing assets, some other interest-bearing investments instead of these, because interest rates are now higher and they're more attractive, right? So as interest rates increase, you start seeing money come out of those three safety sectors: the consumer staples, real estate, and utilities, because those dividend yields don't look quite as attractive anymore. Okay, so if you believe this market narrative that interest rates are going to increase, inflation maybe slightly moderately higher, then yeah, you do want to avoid these safety sectors. I would say, with the exception of real estate, I think real estate can do better here. I think a lot of this lower return analysts are seeing on real estate stocks is just because real estate has done so much this year. Real estate is like the first or second top performing sector so far for this year, and it's because of that inflation worries, right? People are plowing their money into real estate stocks, as a hedge against possible inflation. Okay, so I think real estate can actually do better here than the analysts expect. I would avoid those utilities, those consumer staples, because I don't think those are going to do quite as well. Energy, industrials, materials, I think can do well. As as interest rates increase, the economy sputters along pretty well. So that's kind of where the market is as far as the valuation. I want to get back to some of these signals, though, that we're looking at in the market. Some of the biggest signals that we're looking at as far as signs of a stock market correction, signs that this could be worse. And trying to find the graph here. One of them is margin debt. Okay, and when you're looking at these things, it's not that. When you're looking at stock valuations and prices, price to earnings, that kind of thing, stocks don't crash or stocks don't fall just because they're expensive, right? If that were the case, then stocks would have been falling all the way through the last 10 years, because stocks have been expensive for at least 5 years, maybe even more, but especially these last couple of years. Stocks have been ridiculously expensive versus the history and versus those PE ratios. But stocks don't fall just because they get expensive, okay? You've got to have a catalyst, and then you've got to have things that kind of exacerbate that correction, okay? So right now, and corrections, 5-10% corrections are actually extremely common. Research by Charles Schwab shows that stock market corrections of 10%. So the indexes, S&P 500 falls by 10% in a from the peak down to the trough. Those actually come every other year, about every 2 years, right? They looked at the last, I believe it was the last 30 years on that research, and they had 15 times that the stock market fell 10%, right? So that's pretty common every other year. The 5% corrections, so a little bit less corrections, those actually generally happen almost twice a year, right? 1.5, 2 times a year, where stocks will actually fall about 5%. And we haven't had that for a year. So I think a lot of investors have been kind of spoiled, right? Because we haven't had even a 5% correction in more than a year. And so a lot of investors think that stocks just go straight up, right? But so you gotta watch for some of these warning signs, and one of the biggest ones that I've been watching that I've covered on the channel is this margin debt. Okay, this is obviously when you borrow money from your broker, from that trading platform, that investing app that you use, when you borrow money to invest, right? So say you have $50,000 in your account, you borrow another 50,000 so you can invest a whole 100,000 in stocks. And why not? If stocks are going to keep on going up one way all the way up, then why not borrow on 2 or 3% and get that 10-20% return, right? So that's margin. That the problem here obviously is that works both ways. That borrowing at that lower rate to get higher rates of return, that juices your return on the way up, but it also hits you on the way down. And so what we see is this margin debt, this amount of borrowing to invest, always peaks, always spikes just before a big crash or a big correction. Okay, right? And it's obvious. Usually we see just before a crash, we see the market just jump 20-30% in the previous 2 years. And so obviously people get enthusiastic, people get exuberant, right? They borrow more to invest because they think, if I can borrow at 2 or 3% and make those 20 or 30% returns every year, then I'll be rich in about a year and I won't have to worry about it. So you saw these big spikes. This blue line here is the margin debt, the change billions of dollars. So the increase in margin debt each year. And of course, you saw those big spikes there before the previous two crashes, 99 and 2007, huge spikes, $150 billion spikes in margin debt out in the economy. And this is generally only about 1-2% of the of the market size, that kind of thing. So not real big, but it did translate into huge crashes, some of the biggest crashes we've seen in history, right? Well, now look at what has happened over this last year. This increase in margin debt, $350 billion, okay? Over this last year, investors have borrowed $350 billion more dollars on margin to invest in the stock market, okay? So, of course, what happens is, when stocks do come down, then people start getting those margin calls. They start, the value of their stocks starts falling so much that the investing app, the brokerage, they say, hey, we need more collateral, so we're going to sell some of these shares. And it's just forced selling that exacerbates the market correction and exacerbates any kind of a correction that we do get. So that's a big signal. Last one here, and then we'll get to kind of how to use this to invest, some investing strategies that I'm looking at. And the last one I want to look at, it's actually Warren Buffett's favorite valuation measure. Okay, this is the total market cap to GDP ratio. Okay, so basically this is the total market cap of all stocks, right? And they usually use U.S. stocks. So the total market size of all stocks in the U.S. On the U.S. exchanges to the size of the economy, right? And so that's the green line here. The TMC to GDP current is 205%. So the current value of all stocks on the U.S. exchanges is twice the size of the economy. And Warren Buffett has said in the past he likes to see. Obviously he likes to see it when stocks, the market cap is less than the value of the economy. Obviously, the lower the better, because that's a discount on stocks relative to the economy. But obviously, anything over 100%, when the total market cap of all stocks in the market become higher than the economy, that's a warning sign. And you saw even in some of the big crashes, even in 1987, right? It was only like maybe 60% total market cap to GDP. You've got, we didn't see even until this millennium, okay, the 2000s, when we started seeing total market cap to GDP rise above 100%. So obviously there, the first big spike is 2000, the big tech boom, the big tech bubble, almost reached 150% before it fell all the way down to 75%. Again, before the next little bump there is the financial crisis, right? The stocks really jumping there before the crash in 2000, and stocks actually made the peak in October of 2007. That's where the peak was before that big crash, 2008, 2009. but they actually reached 100% total market cap to GDP. Then fell all the way down to 50%, right? Down to March of 2009 was the trough there in the last market cycle. And now, I mean, just look at this, and this is just going back to everything we've seen, everything we've seen with that increase of money supply, 40% over the last year, the Fed support, the Federal Reserve pumping money into the system, and what it's done to stocks. And you can really see here, stocks on the U.S. exchanges are now twice the size of the U.S. economy. Okay, 200%, 205% right now. Okay. So these are undeniable warning signs, and again, folks, it's not that I'm trying to scare you. I'm not saying sell all your stocks. I'm not trying to spread fear and all this crap. Okay, but this is something you have to know. You have to understand. You have to be watching. You can't just ignore it. Okay, like we said, things don't go away just because you ignore them. And even if everybody was positive Pam and all that kind of stuff, the market could still fall. The market doesn't care whether you're saying it's going to crash or not. Okay, so do nothing isn't really an option for a lot of investors. The one thing I would say, if you're a long-term investor, if you have more than 10 years to retirement, okay, then yeah, you can just keep on dollar cost averaging every month. Every month you put money into your stocks and buy, and you don't really have to worry about it, okay? Because if there's one thing, like we said, if there's one thing that is market, that is a truth of the market, is it's always going to eventually go back higher. Okay, the market is always going to recover. It's always going to make those newer highs. It might take a while though, and that's why I say if you've got less than 10 years to retirement, that's when or if you just do a little bit more short-term investing strategies, that's when you really need to pay attention here, right? Because like we saw, it took 35 years after the 1929 crash. It took 35 years for the market to reach that peak again. Okay, after we've been talking a lot about inflation lately, stagflation. That stagflation years from 1966 to 1982, that was 17 years. The Dow Industrials Average reached 1,000 in 1966. It didn't reach that point again until 17 years later, 1982, right? So, if you look at something like that, if you've got, even with that, if you've got 17 years left to retirement, then this is still something you need to be watching, right? Because, that's a long time to watch your investments just kind of flatline, okay? So, not that we're trying to spread fear here, but this is something you just can't ignore. To ignore it is just ridiculous. Okay, so what do you want to look at? Inflation. The one thing that I'm extremely sure about, folks, is we're going to get higher inflation. Okay, it's going to be higher than the Fed expects. It's going to be higher than economists expect. They're already increasing their inflation expectations of what they see as inflation. They're still saying it's going to be transitory, which is crazy. They have a number and they keep on increasing the number that they're saying is going to be inflation, and they still keep on saying that it's transitory. They still say that inflation is going to go down, and it's just not going to happen, right? You can't pump 40% more money into the system in 2 years and expect not to have long, pervasive, intense inflation. Okay, obviously it's not going to be like what we saw in the 70s. It's not going to reach double digits or anything, but it's going to be 5%. We're going to have 5% or higher inflation for quite a while, I think. And again, as we start seeing those owners' equivalent rents start hitting the CPI numbers, that's when you're really going to start seeing how long lasting that is. So, inflation protected assets, you look at things like gold, gold is already kind of expensive. If you look at the price return of gold over the last 20, 30, 40 years, even 50 years, it's done about 9% over the past 20 years, right? So which isn't really typical for gold. It's a little bit higher than you would expect on just normal supply and demand characteristics. So gold, will do well with more inflation, but it's already pretty expensive. So I don't think that's your best bet for that inflation protection. Real estate, as much as home prices have gone up, I think they still have some support under them because of that inflation. Those real estate stocks, those REITs, are going to be another good sector to be in, right? I think those continue to do well. as well as some of these other inflation protection ones. Actually, I've got a stagflation video coming on Friday. I've got it scheduled for this next Friday. Make sure you check that out. So make sure you're subscribed to the channel and click that bell notification so you get notified when that comes out, because that's going to give you a much deeper look at inflation and stagflation, which is really becoming an issue. It's not that you don't need a recession to have stagflation, folks. You don't need economic growth to come down to zero or negative. You just have to have inflation that's higher than that, and that is what we're seeing right now. Over this next year is the real potential for stagflation. So you need to know what that is, how it affects stocks, as well as just personal finances, as well as your bank account. So be sure to check that out on Friday. Bonds actually in stagflation, during stagflation times, and even inflation aren't the destruction that people say they are. Okay, the wisdom out there is that higher interest rates, higher inflation kills bond prices, right? And that's true. Bond prices do come down with higher inflation and higher interest rates, right? But it's not necessarily the destruction a lot of people think. If you actually look at the data from 1966 to 1982, when we had that big bout of that 17 years of stagflation, last time, and I looked at this for that video on Friday, when you look at that, bonds actually beat stocks during that period. And people are blown away by that. People think that bonds are just trash, any type of an inflationary environment, any stagflation. But bonds actually beat stocks on a return basis from 1966 to 1982. And the reason there is because, obviously stagflation, part of that stagnation is that lower economic growth, earnings from companies really underperformed. So stocks came down. They had just come off of a big bull market, right, before 1966. And much like we have now, stocks have gone up to record valuations. So, over that 10, 15, 17-year period that we saw back then, and, kind of equivalent to right now, I mean, if earnings growth does slow down and we don't get that earnings growth that we're expecting, especially from these growth and tech stocks, then stocks can flatline. Stocks, like I said, the Dow hit 1,000 in 1966 and didn't reach that point again until 1982. That's 17 years of zero return on stocks. The only return from stocks during that period was dividends, right? Stocks actually did a 5.8%. Actually, I want to say about a 6.8% return over that period, annualized return over that period, because that was the dividend. That was the dividend rate. Okay, so stocks did provide a positive return, but only on those dividends. Okay, bonds during that time actually produced a 7.4% return. Okay, and why is this? Why are bonds not completely destroyed during this inflationary stagflation environment? Right now. And it's because of duration. Okay, it's because bonds pay those semi-annual payments, right? They pay that coupon twice a year, and then they mature and they pay back all your money, all the coupon or all the bond price, right? So you can take that money and reinvest it on new higher interest bonds, right? And so what you want to do is you want to focus on shorter dated bonds, right? If you do have bonds as a part of your portfolio, and I think everybody should have some bonds in their portfolio, you want to look at the bond funds that are a little bit shorter term bond funds, right? Like the Vanguard BSV, that's the Vanguard short-term bond fund, right? BSV, it holds bonds shorter dates, right? I think the duration in that, which is kind of the average life of the bonds it holds, is like 2.8 years, right? So that says that the average bond in that fund matures in less than 3 years, right? So if we do start getting higher inflation and it's persistent, then every year they're rolling over bonds. They're having bonds mature. But every 3 years, the average bond has already matured. They get that money back and they can reinvest it in higher interest rate bonds, right? So that's why bonds, aren't necessarily the destruction that people think they are in inflation. Now, what I will say, if we do get inflation, higher inflation, but also higher growth, so we're talking about stagflation. We're talking about high inflation, a little bit lower growth. That's when bonds actually do better than stocks. If we do get, still keep on getting higher growth, then stocks can still outperform. Okay, they can still do better because you've got those earnings growth boosting stock prices. Okay. Last one for investing strategy here, and then we'll get to some of your questions. Cryptocurrencies. These are not going away, folks. And I know a lot of you aren't sold yet, but I got to tell you, this crypto, Bitcoin, Cardano, Ethereum, Matic, really the four coins that I'm investing in. There are a few other altcoins that look really good, but the big coins, that is my highest confidence play. Okay, you've got more countries recognizing these. You've got El Salvador made it official, legal tender this week. You've also got Panama and the Ukraine that came in to say that started that recognition process in their laws. And what you see is a lot of these emerging countries, right? These countries that get a lot of remittances from people, living in the U.S. or living in Europe, and that's expensive. I think I saw analysis that said, Western Union alone could lose like $400 million a year from the fees that it charges people to send from the U.S. to El Salvador, just because now they're going to be able to do it, through Bitcoin and without a fee, right? So a lot of these emerging countries, they are very much on top of this because it's going to mean a boost to their economy because their expats, their people living abroad, aren't paying those fees. So you see a lot of that. You see a lot of a lot of these emerging countries that don't want that dependence on the U.S. dollar anymore. So they're transitioning to it. MasterCard and Visa have both announced over the past couple of weeks huge acquisitions into the cryptocurrency space, making it possible in the future that they're going to start accepting cryptocurrency payments and things like that. PayPal and Square, obviously very big into that space. Cryptocurrencies, it has grown to a point that, and I've got a really important video coming out on Wednesday that is really the intrinsic value of cryptocurrencies that we can get into. But the cryptocurrencies have grown to a point where no one country, no one government, no one regulator or central bank can kill it. Okay, we've heard a lot of central bankers this last week. I think it was the Riksbank there in, I think in Norway. We've obviously got Powell and a lot of people talking about cryptocurrencies. But you got to understand these central banks, the people that control the money supply, the dollar supply and the fiat currency supply. You got the traditional bankers that make their money on that lending, that monetary, that financial system. They're always going to be the biggest critics of cryptocurrencies because they have the most to lose. Okay. The central banks, they control the money in their system, in their country. They obviously don't want to see competition from a digital currency. Okay, the traditional banks, they make billions of dollars. Wells Fargo made almost $9 billion in the last quarter alone, just on taking your money, putting it into savings, and then lending that out. Okay, so what happens when people can just go to a cryptocurrency platform and borrow and lend on that digitally instead of going to Wells Fargo? Okay, so those two people are, you got to take this with a grain of salt whenever you see Jamie Dimon from J.P. Morgan, or whenever you see some central banker say that that cryptocurrencies are worthless or whatever. Now, you'll also see a lot of people. We had John Paulson talking over the last couple of weeks that cryptocurrency is worthless. That's the video that I've got coming up on Wednesday. Okay, we're really looking at the intrinsic value, and there is a real intrinsic value. It's not the stock to flow valuation. It's not the network effect that we've talked about on the channel. It's none of these that everybody always talks about. It is this intrinsic value from the uses of the blockchain, okay? And I don't want to get into too much of it because we have that video coming up on Wednesday, but this is real intrinsic value that is really a great valuation tool for these, for these cryptocurrencies. So again, I mean, as inflation heats up, as the stock market looks expensive, I'm putting more and more of my money in cryptocurrencies. I'm in Bitcoin, Ethereum, Cardano, and Matic. Okay, so 4 coins. Ethereum and Bitcoin, obviously, probably the largest right there. I want to get to your questions here. So I'm going to scroll back up and look for questions in the chat. If I don't see your question, ask it again in the comments. And make sure you use a question mark so I can see see that it is a question. See a few of these. Again, thank you for being here every other Sunday. I'm trying to do every other Sunday. Love these talks with all you out there in the nation. Ohio, Connecticut, Zeke. Phil from Murrieta, California, from NYC. It's awesome. The Birmingham, UK. It's great to see everybody from all around the US or all around the world, really. Okay. So what else? How are you protecting your portfolio from the September effect? Okay. Beach Bum wants to know how I'm protecting my portfolio. Kind of talked about that with this investing strategy. Really, honestly, I'm not putting any more money in stocks right now. Okay, all my money is going into cryptocurrencies, cash. Actually, stocks at 4,500 on the S&P 500. They kind of triggered my next level, and I've shared this with you on the live streams before. But I basically, and this is what I think everyone should do, is you look at the S&P 500 or the Nasdaq. You look at the indexes and say, okay, if the stock market goes up to this point, this is what I'm going to do. And basically, for me, that 4,500 level, that was when I sold more calls against my stocks, right? So I sold other investors the right to buy those stocks away from me. They paid me a premium. It's kind of like a protection against losses in those stocks, right? I still wanted to hold those stocks, but I wanted a little bit more downside protection. So when the S&P 500 hit that 45, I think it was actually like 45.60, when it hit that, then I sold more calls on that. If it goes up even higher, which I don't think it's going to go up that much higher, but if it goes up to, I think my next level is like 46.50, somewhere like that. I'll probably start buying puts. So actually start. I need more beer. That's what that is. So if the market keeps on going up, gets more overvalued, more valuations even go even higher, then I'll probably start buying puts. And basically that gives me the right to sell a stock for a certain price. So if that stock goes down, then I've still got the right, that put option, to sell it for that price. So it's kind of extreme, right? It's because you're actually paying for that right. You're paying a premium for that right. So I'm waiting for the market to get a little bit more expensive, if that goes up there. But new money, I still put money in my account every month. I think, you really need to treat your investments like a savings account. You put money every month, every paycheck, and whether you invest it or not is a different story, but you put money in there, so you can start seeing that portfolio grow, right? So I still put money in there every month. It's just sits there in cash or cryptocurrencies, right? I've started maybe some of the shorter dated bonds that we talked about, that BSV, the Vanguard BSV fund, which is the short-term bond fund, just to earn a little bit more return over inflation and keep my money safe there. Live during football time. Yeah, Billy, why am I going live during football time? This time of year, football time is all the time, right? So it's hard to do. It's hard to find a time when that is. I've found that, right around this time, Sundays, it's kind of most people are available. You can always watch the replay. Watch the replay of this. I'd say I'd watch live football and then watch the replay of this later, though. Dimitir from the Balkans, thanks for being here. Love seeing everybody from all over in the nation there. Looking for more questions. What percentage of money should I keep ready? Mike from New Jersey wants to know, what percentage of money should I keep ready? I'm assuming you mean cash there. And again, this is a lot, kind of a personal question, right? You have to understand, how far out till you need that money, for retirement. How far out do you need stocks? So what's your risk tolerance? If you're going to get spooked by a 10% crash in the market or correction in the market, then maybe you want a little bit more in cash. Maybe you want a little bit more in some of these safer stuff like real estate, gold, bonds, that kind of thing, cryptocurrencies. Whereas if you've got more than 10 years till retirement, if you don't worry about the ups and downs in your stocks, then you don't really need to do quite as much. Okay, you just invest normally and watch your stocks over that longer period, watch them go up higher. So it depends on really where you are. Personally, I'm kind of a risk averse investor, right? A lot of my business depends on the stock market and that kind of thing and how well it's doing. So if the stock market crashes and people get disinterested in stocks and that kind of thing, maybe they watch fewer videos, right? So I not only lose some of my income, but I lose some of my investments as well. So anytime you're in that situation where your job is kind of tied to the economy and tied to finance and that kind of thing, and that's not necessarily just stocks. If you work at a bank, that is very cyclical job, right? They have a lot of hiring and firing according to that economic cycle, right? So if stocks were to fall, if the economy was to fall, that kind of thing, then you could face losing your job and your investments at the same time. So for people like that, for people like myself, small business owners, maybe you have a little less risk in your portfolio. So I tend to have more cash, actually, more cash, more bonds, more real estate, more more in my own business, that kind of thing, rather than stocks. Actually, I love talking about stocks. It's where I got my start. It's where the obviously my passion is in the channel. But I actually own less stocks than most people believe. So right now, actually, I think cash, I'm right around 15-20% cash. I've also got a lot of option hedges against my stocks, so a lot of calls sold against those stocks, that kind of thing. I've also got probably, actually, right now, it's probably higher at about 20-25% in cryptocurrencies, right? I've got so it's about 270 on BlockFi. It's another 250 on Coinbase. So upwards of 500,000 in cryptocurrencies, right? And that's again, that's just because I think that is my highest confidence bet right now in cryptocurrencies. I truly believe if you look at some of the valuation videos on the channel where I think cryptocurrencies could go, Ethereum, Bitcoin, some of those others, I mean, it would not be a surprise to me to see Bitcoin up to 80-90,000 by the end of the year or early next year, right? Which would be about a twofold return, about 100% return, from the current price. When do you get that on stocks? Even this last couple of years where stocks have just gone up like crazy, you just don't get 100% return within a year, and I really think that's where we're at with cryptocurrencies. So I've got a lot in cryptocurrencies right now. Okay. Aaron wants to know how much further will Chinese stocks drop if the stock market crashes? Great question. And actually kind of two questions there. One is, should you invest in Chinese stocks, period? Or will Chinese stocks do better, or will they do okay even if the U.S. market doesn't crash, right? So if the U.S. market crashes, or if we see a significant correction in U.S. stocks, I think Chinese stocks are going to come down just in sympathy, right? Investor sentiment is a big part of stock prices, right? So if the U.S. market, they used to say if the U.S. economy, sneezes, the rest of the world catches a cold, right? And that's still kind of, we've kind of diversified the global economy a little bit, but that's still, something to watch in stocks. So if the U.S. market struggles, then you're going to see lower Chinese stock values as well. But even if the U.S. market doesn't struggle, even if U.S. stocks keep on going, I think it's these Chinese stocks, it is a nightmare, right? And this is coming from somebody that has invested in Chinese stocks. I held Alibaba for a long time, and I think it's a great company, but the government has just made these uninvestable assets. Okay, you cannot compete with a government that wants to return further and further towards socialism, towards that communist ideology. They've started limiting what kids can do. They've started. I mean, you just look at some of the language coming out of the government over the past few months, and it's really, really trying to scale back the excess in wealth and capitalism and that kind of thing in the economy. Now, it's not to say that you make some really good money if you're able to get the dip on those, and they do come back up. And what we're seeing a lot of time with these is, they'll crash down on one day on something that the government does, and then next few days they'll come back up a little bit. So if you're trading these, then you can make some money. If you're a longer term investor or even a swing trade investor, it's going to be very hard to make money in Chinese stocks. So I'm not touching them. I wouldn't recommend people touch them right now, just because there's other opportunities for return and not have to worry about the government as well. Rakshith, thank you. Appreciate it. Michael Reisberg, thank you for being here from Denmark. What else? Same question as Nolan. Curious where a firm will go from here. I really couldn't tell you about a firm. It's that buy now, pay later kind of idea, which is really interesting, because when I was a kid, and that was a long time ago, so back in the 80s and mostly the 80s, but early 90s as well. Obviously layaway was the big thing. So now it's buy now, pay later. So it's interesting seeing that's part of the market grow and develop and evolve. But I really haven't covered these stocks. Obviously the valuations are very high for a lot of these companies because of the acquisitions that have been happening. I do like what I do like is this idea of the digital wallets, right? So you look at PayPal, you look at Square, you look at a lot of these companies, and even Coinbase to an extent, if they start diversifying a little bit more. But you look at these, online financial companies. These mostly PayPal and Square is what we've looked at on the channel in the past. And if you go to the video section and search for digital wallets, you'll find the video I'm talking about. But right now, I mean, these companies are creating, really a whole financial services universe, right, on their platforms. Okay, in the past, PayPal is basically you just think about it as billing and money coming back and forth and that kind of thing. But they really have a huge potential in these sites for everything financial. I mean, insurance, lending, anything you would do at a normal bank, you're going to be able to do on PayPal, on Square, on a lot of these, as well as just a lot of the data management that they can do as far as advertising and that kind of thing. So I mean, PayPal and Square have been two of my best investments over the last year or so, just because I mean. Even you look at some of the weakness in some of these other growth stocks, these other tech stocks, and you just haven't seen it in PayPal or Square because these valuations are really actually even pretty good for these digital wallet companies, these financial services companies, and that's what they're doing with these acquisitions into these buy now pay later companies. They're adding another part onto those digital wallets, right? They've got they've got the transactions, the processing, that kind of thing. Now they're getting the lending and that kind of thing. Okay, what is it? Paul, Simplify, what else? Looking for more question marks. Jobs are ineffective. So a lot of talk about the labor force, the work from home, that kind of thing, and yeah, that is a really a huge thing that I think most investors are kind of missing right now, kind of not paying attention quite as much as they should to the labor market. I mean, there's a huge demand problem with jobs, right? And people just aren't taking the jobs for one reason or another. So, I mean, it's a really big. Something I think is going to feed in that inflation argument. Obviously, companies, if they can't find the workers they need, they have to raise prices. They have to convince those workers that don't want to go back to the office ever. They have to pay them enough to convince them to come back, right? So wages are going to start going up. Wages are going to go up a lot more than I think the Fed or economists are modeling right now, and that's going to feed into those inflation expectations. Okay, what is this not currently being seen? What else? Short the market now. So M. Monroy wants to know if you should short the market right now. Like I said, I right now at this point I'm mostly in. I've gone mostly market neutral, not necessarily market short, but market neutral, right? Where I've got a lot of cash, got other assets like bonds, real estate, cryptocurrencies, a lot of assets outside of the market. So it's more market neutral rather than shorting the market. Now I will tell you, I do have like a put spread, a bear put spread on the QQQ and the TLT. Okay, so the QQQ is the Nasdaq 100. Basically, I've just got I've got I bought the 370 puts and sold maybe the 360s, right, if I remember right. And then with the TLTs, I've bought the 350 puts and sold the 340s, 335, something like that, right? So basically, this is just hedging my other stocks, right? I'm not selling stocks, right? But I do want some protection if the market does weaken or if interest rates go up in the case of that TLT. So I want some protection, some hedges for that. So I've got some of these put spreads that can pay off a little bit more if the market does come down or if interest rates go up. So not necessarily shorting the market or betting against the market, but I am hedging, and I've got more of a market neutral idea. Okay. What else we got? No vaccine. Mr. Hogue looks worried. He's usually happy. No, not necessarily. I mean, Yeah, I've been in the market for more than 20 years, right? 20 plus years. I've had about a little more than half of that time as an analyst, as well as working as venture capital, private wealth management. Markets are going to go up. Markets are going to crash. I don't want anybody to lose money, but I'm waiting for a crash. I mean, the crash is when you make your most money, folks. If you can go market neutral or something like that, hold enough in cash, hold enough in other assets, then market crashes can be huge opportunities, right? I do not like the market right now, okay? And it's because it's really hard to make money with stocks so expensive. It's you look at the forecasts of all the major banks. You look at most of the forecasts are for at best like a 4% annualized return over the next 10 years on stocks, and that's basically just because the valuations are so high right now. Valuations, like we saw, about a 30-40% premium on valuations. It's really hard to make money there, and I'm lazy. I like it when it's easy to make money, right? So I need stocks to come down. I want stocks to come down a little bit to make that a little bit easier. But I'm not worried about it because I do my thing and I make my money and I'm smart with it. So I think that's the biggest thing you probably should do is don't freak out when the market. If you're freaking out when the market falls or when stocks crash or something like that, it's because you've got too much faith in the stock market. You've got too much buy-in in the stock market. Okay, unless you're a 24/7 trader or something, then you need to be doing something else to make your money. Okay, stocks aren't going to make you rich, folks. Even over the last couple of years, where stocks have made people a lot of money, cryptocurrencies have actually made people rich and all that kind of thing. You shouldn't be looking to stocks to make you rich. Okay, because it's just that kind of chasing return that is going to bite you in the ass when stocks do crash. Okay, you're going to lose more money than you would have otherwise. So you need to focus on what you do best. Focus on your job or your side business or your side hustle or whatever you can do to make more money and let the market do its job. Don't worry about the market though. Okay. What else? I've kept an eye on VIX. Probably will drop. Okay, crash is coming big time. Okay, so I'm not seeing a lot more questions, so I'm gonna actually cut it off early. Again, thank you for being here. I love doing these every other Sunday live streams. Just talking back and forth with you here. Got to take my kids to the mall. I promised to take them out there today. But again, subscribe to the channel. Make sure you have the notification bell turned on. It'll be probably not next week, but another 2 weeks, and we'll have another one of these live streams. If I didn't get to your question, ask it in the comments below, and I'll try to get into there. Thank you.